Hello, friends. RBI didn't just cut rates today, they quietly changed the direction of your entire portfolio. In this video, I will break down December Monetary Policy Committee decision in plain English and show you exactly how and what it means for your equity funds, portfolios, AIF PMS, and also the home loan over the period of next 1 year. So this is Rajat Dhar, managing partner at Finogent Solution at Premium Wealth Management Firm, uncovering the facts here about the RBI monetary policy review. So, therefore, why this matters now? Now, this is the first clear step into the easing cycle after a long period of high real interest rates. So, if you are an Indian investor and you ignore this move now, you risk being in the wrong asset class at the wrong time. So, therefore, we will cover in this four different parts. What exactly RBI decided in this meeting, what has changed in growth and inflation that is behind the scenes, and how this impacts different investors, equity, debt, AIF, and borrowers. And finally, my own CIO framework on how to think about your portfolio after this rate cut. Now, the simple exam explanation of this event could be, let's start with the headline. The Monetary Policy Committee met from 3rd to 5th of December 2025 and has cut the repo rate by 25 basis points to 5.25%. Along with that, the standing deposit facility is now at 5% and marginal standing facility and the bank rate are at around 5.5%. They have kept the policy stance neutral, which means that they are not promising a long series of cuts, but they are clearly opening the door to easier conditions ahead. So, therefore, now here is where it gets very exciting. RBI is cutting rates at a time when India's GDP is growing at more than 8% and inflation is around 2%, in fact, at an all time low in October. That combination almost never happens. So the real question is, what are they seeing in the data that we are not seeing as investors? And what does that signal for markets in 2026? So therefore, let's go a bit deeper into it. On the growth side, RBI notes that the real GDP growth of 8.2% in the second quarter with the GVA at 8.1%. Domestic demand is still resilient, rural demand is robust, urban demand is recovering, private investment is picking up, and bank credit is supporting tech capex. But they are also acknowledge early signs of softening in some leading indicators and continued weakness in merchandise exports. Based on this, RBI is projecting 7.3% growth for financial year 25-26, with growth slowing from 7% in current quarter to 6.5% by the fourth quarter and then stabilizing around 6.7 to 6.8% in the first half of FY 26.7. In simple language, growth is strong today, but we are past the peak and moving towards a more normal 6.5 to 7% range. Now, here is the inflation story. Inflation is where the real story is. Headline CPI has dropped sharply, driven mainly by correction in food prices. That is actually better than what we see usually in September and October. Core inflation, which removes the food and fuel, has been contained despite higher prices in gold and precious metals. In fact, core inflation excluding gold is just 2.6%. That is extremely very comfortable number for RBI. RBI now projects headline inflation at around 2% for the full FY 25-26, with quarter 3 inflation almost zero at around 0.6%, quarter 4 at 2.9%. For the first half of FY 26-27, they expect inflation to be near 4% target. Now, they even say that underlying inflation is lower than what the headline suggests because gold alone adds around 50 basis points to that number. Now, put together, this means inflation is not just under control, it is well below the target for now, giving RBI significant headroom to support growth. So now, how is RBI thinking about this balance? The committee clearly believes that the inflation shock is behind us. Food supplies look comfortable, global commodities are not a major risk right now. Growth is still solid, but there are enough global and external risks to justify some policy support. And with the repo rate at 5.25% and inflation near 2%, real interest rates are really too high. That is why they have started cutting. But they have kept the stance neutral to preserve the flexibility. One member even wanted to shift the stance to accommodative, which tells you that the part of the committee is already thinking of more sustained easing cycle. My read is that this is the first step of the measured data-driven easing cycle, not a one-off token cut. Now, therefore, if we look at the segment-wise impact and what it means for the investor, starting from debt, when RBI starts cutting, the bond yields at the shorter end usually reacts first, and then the rest of the curve follows depending upon how credible the easing path looks. In this, if this easing continues, duration funds and gilt funds can do well over the next 12 to 24 months because as yields fall, the bond prices goes up. High quality corporate bond funds also benefit as spreads can compress and borrowing costs reduce. For those of you who are sitting heavily in FDs just because rates look attractive, this is your early signal that peak FD rates are now behind us. You don't have to rush, but mentally prepare that reinvestment rate. That is when your FD is going to mature over a year or so, and then you're reinvesting it. It will be at a lower rate of interest. So if you have got FDs booked at a shorter tenure, you stand to lose. So therefore, when we now come to equities part, especially banks and NBFCs, in the short run, falling interest rates can put some pressure on their net interest margins because leading rates adjust faster than the deposit. The lending rates adjust faster than the deposit rates. But over a cycle, lower rates plus healthy credit growth is usually a positive for well-run banks and retail NBFCs. If we talk about rate-sensitive sectors like housing, autos, discretionary consumptions typically benefit from the lower EMIs and the easier financing conditions. Real estate, home improvement, building materials, all of this can see better demand if this easing cycle plays out fully. For the broader market, the combination of strong growth, falling rates, benign inflation is actually a very supportive macro backdrop, especially for a domestic demand-driven market like India. And when we talk about alternates, and their strategies. And if you invest through AIF or a PMS structures, the impact is slightly more nuanced. Yield-oriented AIFs, credit strategies, REITs, InvITs can benefit as lower rates make their cash flows more attractive related to FDs and government bonds, assuming, of course, the credit quality remains strong. On the equity side, high quality, long only PMS portfolios may see tailwinds from a more favorable growth and liquidity environment provided valuations don't run ahead of their fundamentals. Some strategies that use leverage or structured products may also benefit from the lower cost of funding over time. If you ask me about my own CIO framework for this, how I think about my portfolio or other things, so I would like to break this reaction into three buckets. Bucket one, no action assets. The long-term equity SIPs, core asset allocation, and goal-based portfolios, I would not like to make any change. I will keep it like that. For most investors, there is no need to tinker with just because of one RBI rate cut. Bucket two, which is called as adjustment assets. This is where you evaluate, are you overexposed to a very short-term FD or an ultra short-term funds at a cost of duration? Do you have an opportunity to gradually add a bit of high quality duration to lock your current yields before they fall further? And with this rationale, now if we move to the bucket three, which is called as a watch list assets, here I place credit heavy products where I would be careful not to chase yield blindly, but just because FD rates have started dropping. Very rate sensitive speculative trades in small caps, leverage strategies can be considered here. The key is not to react emotionally, but to recalibrate systematically. So now the unique angle of this is, there is one more thing that I want you to remember, guys. Markets often react to the headline repo rate, but professionals watch two things very closely: the stance, that is whether it is neutral, accommodative, or withdrawal, and the liquidity guidance, which tells us how much money is actually sloshing around in the system. Right now, RBI has cut rates but kept the stance neutral. That tells me that they are willing to support growth, but they are watching the data very carefully. If in the next meeting or two you see the stance shifting to accommodative and the liquidity turning easier, that is when the markets will really start pricing in deeper easing cycle. To summarize all this, we have likely entered into the early phase of an easing cycle. Growth is strong, inflation is very benign, and the real interest rates are higher than needed. Debt investors, fixed income investors have a window to position for falling yields, and equity investors are operating in a favorable macro backdrop as long as they respect valuations and risk. If you would like us at Finogent to review your portfolio or give you a perspective of how the market goes with this RBI move to see whether your equity, debt, or alternative allocations are aligned to this environment, my team and I would do which we do it for our clients. We'll be very happy to accommodate you. So there is a link below where you can request your portfolio gap analysis. And if you found this breakdown useful, subscribe to the channel so that you don't miss out on next macro update. We will try to cut through the noise and tell you what really matters for your wealth. I'm Rajat Dhar from Finogent Solutions. I will see you in the next one. Thank you so much.